Observe the moment when the 50-day moving average crosses above the 200-day moving average. We initiated a buy position, and over the following period, it gave us a profit of 200%. Huge winning trade. Intrigued? Stick around to learn how mastering moving averages can transform your trading journey to a profitable trader. Welcome back to Financial Flow Channel, your go-to destination for trading and investing. If you're passionate about enhancing your trading skills and feeling confident in the markets, you're in the right place. And before we continue, don't forget to like this video, hit that subscribe button, and ring the bell to never miss future content. It's free for you, but super important for me. It helps me continue creating free content like this. Now, let's uncover the secrets of moving averages. Moving averages are necessary tools that smooth out price data to reveal underlying trends over a specified period. Think of them as a pair of glasses that help you see the bigger picture. Whether you're using simple moving averages, SMA, exponential moving averages, EMA, or any other variation, these dynamic indicators offer invaluable insights into market direction and potential trading opportunities. So how do moving averages work? Simple moving averages provide a straightforward representation of price trends by calculating the average closing prices over a set number of periods. It's like taking a step back to look at the overall picture. For example, if you are on the daily chart and you are using a 50-day simple moving average, it's the average closing price over the last 50 days. If it's a 1-hour chart, then it's the average closing price over the last 50 hours, etc. On the other hand, exponential moving averages assign more weight to recent price data, making them ideal for traders seeking more responsiveness to recent price changes. It's like zooming in to see the finer details. They can be used for trend continuations, for example. If there's an uptrend and the price retraces back to a 200-day moving average, we can use that moving average line as a support line. If we see a bounce, then we can go long on this trade. They can also be used for trend reversals by combining two moving averages on the same chart, a slow one, such as the 200-day, with a faster one, such as the 50-day. So, if we were moving in an uptrend and suddenly the 50-day moving average crossed below the 200-day moving average, we could have gone short on this trade. You can also change the period number to any number you want. The choice is yours, but the most used ones are the 20-day moving average, 50, 100, 150, and 200. We'll now illustrate everything with real trade examples. Let's look at a simple trading scenario on the daily chart of Apple. Notice how the 50-day moving average crossed above the 200-day moving average. This could indicate a bullish signal. After the moving averages cross, we wait for the price to move above the moving averages. We can see it happening after 23 candlesticks. We can buy a long position after this move and set a stop loss below the most recent low, and the take profit will be when the moving averages cross again to the downside. Over the next period, the stock rose a lot, and we closed our trade with a profit of around 200% after the moving average crossover. Huge winning trade. Now, let's consider a bearish scenario. In the daily chart of Amazon, we can see a moving average crossover to the downside, where the 50-day SMA crossed below the 200-day SMA. This is a bearish signal. We can open a short position immediately after the crossover, or we can wait for the price to come back and retest the 50 or the 200-day SMA. To choose which moving average you will have as a support or a resistance line, you need to know your trading style. If you are a more aggressive trader, go with the 50-day moving average. If you are trading in a safer way, then 200-day moving average is your go-to choice. For instance, the 200-day moving average represents a stronger support or resistance area compared to the 50-day moving average. Generally, the longer the period of the moving average, the stronger the support or resistance is. Let's say on this example that we short sell the stock immediately after the crossover. We sell the stock, we set a stop loss above the most recent high, and we wait until we see the next moving average crossover to the upside to close our position. Later on, the 50-day moving average crosses above the 200-day moving average, and we close the trade with a profit of 14.3%. Not bad trade either. However, not all signals lead to profitable trades. For instance, in the daily chart of Microsoft, we see a moving average crossover to the downside. We decide to go short here after the 50-day SMA crossed below the 200 SMA. So we short the Microsoft stock, we set a stop loss above the most recent high. A few months later, the price didn't go down as we expected. It went back up and the 50-day SMA crossed above the 200 SMA. So we decided to close our short position with a loss of around 7%. Small loss, but still a losing trade. This example highlights the importance of using additional indicators and techniques to confirm signals, as we will check another example now. Let's examine a trend continuation scenario where the moving averages converge with support and resistance levels. In the daily chart of Amazon, we observe the 50-day SMA converging with a key support level, reinforcing its strength and potentially signaling a strong buy opportunity for traders. While the price exhibits an uptrend, there's an important resistance level as seen in historical data, marked by multiple bounces. This resistance line initially constrained the price, but upon breaking, it transitioned into a support line. Following this breakout, the price retraced to our 50-day SMA, coinciding with the support line's location, presenting a compelling buy signal. Taking advantage of this convergence, we entered the trade and placed a stop loss below the support line and the 50-day SMA, or for safer, below the 200-day SMA. Later, we closed it with a 56% profit when the moving averages crossed downward. For a deeper analysis of support and resistance levels, check out our previous video by clicking here after you finish the video you are watching now. I will have the links in the description as well. Lastly, let's consider the scenario where moving averages converge with trend lines. In the daily chart of Google, we see that the 200-day SMA is converging with an upwards trend line. This convergence could indicate a strong support level and a potential entry point for a long position. As we can see here, we have two touches, so we decided to draw a trend line. After we drew the trend line, we can later see that the price retraced back to the 200-day SMA, and it's also converging with the trend line. We decided to initiate a long position after the green candlestick closed, with a stop loss below the trend line and the SMAs. The trade closed with a profit of 32.50% after the moving average crossover to the downside. For a deeper understanding of trend identification and trend lines, watch the last video. This will also be in the description. Moving averages serve as invaluable tools for traders seeking to decipher market trends and seize trading opportunities. Whether you're a trend follower or you prefer short-term trading strategies, mastering moving averages can provide you with a competitive edge in the markets. Have you used moving averages in your trading strategy? Share your experiences in the comments below. Before we conclude, I'd like to give you a sneak peek into our next video, where we'll explore how to integrate the Relative Strength Index, RSI indicator, with moving averages, support and resistance areas, and trend lines to enhance our trading decisions. By combining these powerful tools, we can create more convergence and gain deeper insights into market dynamics, leading to more informed trading choices. That wraps up our comprehensive guide to moving averages. If this video helped you, don't forget to give it a thumbs up and share it with your friends. Stay tuned for our next video by subscribing, where we'll analyze advanced trading techniques using the RSI indicator. Until next time, happy trading. Before you go, I'd like to recommend the broker I use, eToro. As one of the industry's leading brokers, eToro offers thousands of assets, transparent trading fees, speedy withdrawals, and a user-friendly interface. One standout feature is copy trading, which enables you to replicate the portfolios and trading strategies of successful investors with ease. You gain access to their trading statistics and history, and once you've copied them, you retain full control over your portfolio for any adjustments you wish to make. If you would like to have a look, click the free link in the description below.